I'm going to run you through our investment philosophy and how we think about investing at Providend, how we look at asset classes, what considerations we make when we invest. And this will help you understand why we feel that, staying invested in equities is still relevant even today. Right? We sort of use it as the framework that to look at how we want to invest in, and it centers around 4 pillars. First one is economic contribution. Second is empirical observation. Third is implementation. And the fourth is practical considerations. And let me run you through in a bit more detail what I mean with each. So what does each pillar represent? So economic contribution, there must be some economic theory, rationale, and most importantly, value add that enables this investment to generate long-term returns. Right? We want to see that when we invest in something, there's a reason for it to have a return. Right? It must be making certain kind of cash flow for you to have a certain type of return. If you invest in something and there's, typically the only reason that it might make money is if somebody wants to pay you more for it sometime down the line. I mean, it's not that it's a bad investment if you can get somebody to pay you more for it sometime down the line, but then there might not be a sound economic reason for there to be a return on this investment. So that's something we want to consider. Empirical observation means we are fairly data driven. We evaluate, real world market data, see if this investment does deliver long-term returns. We don't want to just take, a short time period or just some 1 or 2 data points. We want to see that many data points just to be sure that what we are investing in makes sense. Implementation, and that's a very key part, right? Can this investment be added to the portfolio in a cost-efficient way? Does it improve portfolio returns? Does it lower the portfolio risk? So, for example, one big consideration is, does it increase or decrease portfolio diversification? Right? If say there's a new investment that we're considering, and adding it to the portfolio might increase a lot of concentration risk, then that's something we want to really consider, and think about when we are assessing what we invest in. And of course, lastly, practical considerations. We want to consider the goals and preferences of the client because every client has a different goal, every client has a different preference. And so making sure that what we recommend, what we advise the client to do, is suitable is very, very important as part of our process. So let's look at equities through our investment philosophy. Okay, so what are equities? How do they generate a long-term return? But first, equities represent the ownership share in a company or business. As a shareholder, you really own a part of the business, right? If you are a small shareholder of a very, very big company, yeah, you own a very, very small part of the business, but you still own a part of the business. I mean, and owners of the business get a share of the profits of the business. I mean, if there are any business owners in the audience, yeah, I'm pretty sure you're very familiar with that, right? The owner of the company, at the end of the day, after you pay all the staff, you pay all the suppliers, you pay all your costs, you pay the rental, if you have to rent a place, you pay electricity bills, etc. And at the end, the owners of the business get a share of the profits. And why do the owners of the business get a share of the profits? Well, they took the most risk. They're the ones that set up the business. They're taking the ownership of the business. They have to put in their own capital to invest in the business. So as an owner of a company, you get a share of the profits. And so why is that important? Well, the value of a company, i.e. the value of its shares, is typically derived from the value of its future cash flow. Right? If I had a company that was making $1 million a year in profits, cash flow, you wouldn't want to sell it to somebody for $500,000, right? Because that doesn't make any sense at all. When by holding it, you can make yourself $1 million in profit a year, and subsequently in the next few years, at least with a reasonable visibility, you'll still make $1 million every year. So you would want to sell it at a much higher value than that because you believe that there's a lot of future cash flow. that accrues from owning this company. So that's why, you know, we feel that there is an economic value to stocks, right? There's a real reason for them to have a long-term return because they give you a piece of a company, and if that company generates profits, that the value of the company will go up, and that's reflected in the share price. So we feel that stocks, you know, they do meet this criteria of economic contribution. There is an economic contribution. There is a real reason that stocks should have a long-term return. So the next one is you look at the data. Do stocks really deliver long-term returns? As you can see, MSCI World, well, since 1970, you know, over time, stocks have returned quite a considerable amount. And you might say, okay, this is just an index, you know, it's just some numbers. What about real investments and real returns that you can actually invest in? Well, these are some examples of real funds that you can invest in. They have been operating since the early 2000s, and these are their returns. So if you look at the first one, it's the STI Spider STI ETF. It's been operating since 11th April 2002, and it's delivered a 6.58% return annualized. That means every year annualized compounding from April 11th, 2002 to I think the as of date is end of May, end of April this year. You have gotten 6.58% annualized. Next one is MSCI World, which you can invest through the Vanguard Global Stock Index Fund. And that's been operating since December 1998, and there's a return of 6.42%. Last one is the most famous Spider S&P 500 ETF, which tracks the S&P 500 index, operating since January 1993, and you have a 10.35% return. So these are real actualized returns from anybody that had held this fund or ETF since it was incepted. And I mean, so, you know, looking at the real data, stocks have been delivering a positive return over time.